Remortgaging or mortgage refinancing. What do you understand by this term? What comes across your mind when you see or hear this term? When a mortgage loan holder finances or pays off the current loan with a new loan, this is what it means by refinancing. Most of the time, borrowers will choose to refinance to take advantage of low interest rates in the market, shorten the term of payment, and take a new type of loan to pay off the mortgage early or refinance to cash out home equity. At low interest rates in the market, the cost of borrowing will be cheap. So people will want to take advantage of that and take cheap loans to pay for the expensive ones that they had borrowed early when the interest rates were high. When you pay the old loan with a cheap new loan, it will help you to shorten the term of payment, and the term of paying interest rate will also shorten. Thus, you'll save more on interest cost that would have paid for the expensive loan. You may also want to refinance to get a new type of loan with a low interest rate and a favorable maturity term. How to refinance a loan? How will you refinance a loan? So when you want to finance a loan, you will exactly follow the process that you did when you are borrowing the current loan that you want to pay for. But refinancing will be different in that you'll be allowed to choose the rate at which you want to borrow the loan, at the same time, the loan life that you want to take. The new loan amount is what you will use to pay the old one and now start making interest payment and principal repayment on the new loan. Also, in refinancing, you have freedom to choose who will be your lender. You may take a market survey, see who has the lowest interest rates, best terms of repayment, and decide to lend from them. Or if your current lender has the best deal, you may decide to do that with your current lender. So it's not necessary that you'll have to refinance with your current lender. You also have that freedom to choose from who you want to borrow from. Types of refinancing. First, we have rate and term refinancing. This allows homeowners to change the current rate of the loan and term, or change both the rate and term or bond life. You have a 20-year loan with an annual 5% interest rate and you want to refinance it. You may refinance it with a 30-year mortgage loan, which means you have a longer time to service the loan, making it more affordable because the loan amount will be spread over that long period of the bond. Also, you may take or refinance it with a 20-year loan with a 3% annual interest rate. In this case, you will have reduced the interest rate, but still the term is still 20 or remains to be the same, but still it will be cheaper. How? Because the cost of borrowing will be cheaper. You will be paying 2% less of the interest rate, so you'll be saving that, and that's how good refinancing can be. At the same time, it can even be cheap more than that. You may take a 30-year loan with a 3% annual interest rate. So you have both the long term extended and the interest rate lower. So your periodic payment will even be much lower because it will be spread over the loan life. So it will be much affordable for you to pay. The main goal for rate in term financing is always to save money on interest. And by the way, on the extending mortgage life note. We had done a video before, so if you haven't watched it, you can go back and do watch, get the better understanding. From there, you have cash out refinancing. It aims to tap home equity. Assume you have a loan worth $4,000. You made 1,500 deposit. Now you owe the lender or bank $2,500. You decide to take a new loan worth $3,000. So you'll pay the lender 2,500 and you'll have 500 as equity. Note that liquidity is not in liquid form, or rather equity, sorry. So to access it in form of cash, you must take a loan. The 500 earned from the loan is what we call equity. And this amount you may use it in other projects, what you purpose it for. But beware, in cash out, the loan amount of the new loan will always be higher than the current loan you owe the lender. What are the reasons why we want to take or refinance our loans? Is it good, or why do you think you want to refinance a loan? Most of the time, we will finance our loans to clear the debt on your current mortgage because it allows you to choose loan terms, that is the length of the loan and the interest rate on your new loan. So you have that freedom. It also helps you save on interest rate because most of the time when we refinance, we do this when there is low interest rate or borrowing in the market. So you will pay less or the cost of borrowing will be cheap. It's also affordable because you will choose the length of the term and the interest rate, and most most of the time long-term bond lives will help us refinance at a low interest rate or low repayments over a long bond life. Before deciding to refinance a loan, you need to get the right information because you're going to deal with your cash. At the end of the day, it is you going to pay this. So consider the cost of refinancing versus the saving return on the new loan. You may also need to talk to your financial planner to clear the dilemma along with other options you may have. What is it that you want to know about property refinancing or property ownership? How does mortgage refinancing or loan refinancing work in your country? Just type comment below, let us know.